All right, we are looking a little bit of a bounce this morning, 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is on assignment, and Bloomberg Open Interest starts right now.
Coming up, Fed Chair Jay Powell faces a tricky task this week of assuring investors the economy remains on a solid footing. Retail data out this morning adds to concerns of a pullback in consumer spending. And Treasury Secretary Scott Bessent says he's not worried about the market, but Wall Street doesn't seem convinced. RBC's Lori Calvasina cut her S&P 500 target on growth risks, and she joins Open Interest this hour. Also, our big stocks focus today, NVIDIA investors hope a keynote speech from CEO Jensen Huang at the chip giant's much anticipated AI conference this week will give the stock and the sector some badly needed momentum. Let's take a look right now at where markets are trading. We did see a little bit of bounce, very little. NASDAQ 100 futures are still up 0.1%. Maybe that's on hopes the GTC conference from NVIDIA will give us something. You can see S&P futures right now, little change, but there's a red arrow. And the 10-year yield also very little change, holding at that 430 level that Sonali has been watching so closely. I'm watching NVIDIA stock right now because it's a pivotal week for that company and that sector. NVIDIA developers, its developers conference getting underway. The GTC, which I think is GPU Technology Conference, pushing the shares in the pre-market up 1% and change. And you're watching something related.
I am. Pour one out for the humanoids. That is what Morgan Stanley is watching, the humanoid trade here. That is in part in Tesla. The idea here is that the NVIDIA conference could have implications on Tesla's stock, which has seen investor sentiment plummet this year. And remember, Tesla is one of your worst performers on the S&P 500, certainly the worst on the Magnificent Seven. Let's see if NVIDIA can help turn it around. Meanwhile, also politics in focus because Treasury Secretary Scott Bessent says he's not worried about the decline that's wiped out trillions of dollars from the stock market. Bessent spoke on NBC's Meet the Press on Sunday.
Corrections are healthy, they're normal. What's not healthy is straight up, that you get these euphoric markets. That's how you get a financial crisis. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. We are going to have a transition, and we are not going to have a crisis.
All right, so Scott Bessent there assuring the market, but the market's not really assured, right? We've had a number of people cutting targets. Again this week, Lori Calvasina, who's going to join us shortly, has cut her target. And Mike Wilson, in a note I was reading over the weekend, says, you know, the pro-market policy coming out of the Trump administration isn't going to come out till later in the second half at the earliest. So they've really got to reassure us with something else first.
Well, that's the problem. Where's the bottom? Is it in April after we see the next wave of tariffs, or is it later this year after we see the brunt of that pain really come through? That's what no one could tell. And until that's kind of cleared up, it's hard to know how to buy the bottom, isn't it?
And the wealth effect may be hurting consumer sentiment. Take a look at the retail data that we had out across the last hour. Sonali and I were looking at the ECAN function, ECAN Go, on your Bloomberg terminal, and just breaking it down into sectors over the last year. The auto sales have been a real problem. Click into that blue box there, and you can see this is auto sales and auto parts. They just continue to come down. So Mike McKee joins us here on set with his own look at the data. Mike, you've had a half hour now to look through it. What do you see?
Well, it's kind of interesting because this is the first hard data that we've had after a lot of soft data looked at rather negative for the economy. And the headline numbers, as you point out, not so good. Headline sales up just 0.2 after a drop of 1.2% last month. The control group, however, rises 1% after falling 8% the previous month. So basically, consumer spending flat for the last 2 months. The biggest moves were in food and drink, and clothing and department stores. They were down big. Non-store retailers up 2.4%. Now, Matt, you asked what I thought. Here's the thing. February, the weather was terrible. So maybe people were not going out to buy cars, going out to the car lots. We'll have to see how this month does. And we then saw the non-store retailers rise. People stayed home. and bought stuff. Then we had a really bad Empire Manufacturing down 20 points, and then the prices paid the highest in 2 years. That sent short-end rates up, a little bit of an inflation scare there. But speaking of those hard data, the number that will probably matter today to people on Wall Street is the Atlanta Fed's GDP Now number. It's the first time it's been updated. It's going to be updated today with these latest figures. First time since they printed that negative 2.4% that got everybody so freaked out.
Yeah, I'm looking forward to seeing how the market really starts to react to that. Of course, a lot of data ahead this weekend, an FOMC decision. We're going to be seeing so much of you this week, Michael McKee. We thank you so much for your analysis. Also happening this week, we've been talking about it, NVIDIA's GPU Technology Conference. Shareholders are now hoping that CEO Jensen Huang's keynote speech Wednesday will boost optimism around the stock, which has been a bit of a bear this year so far. Let's discuss it more with Bloomberg Intelligence senior analyst Mandip Singh. How high are expectations for this event?
Well, I would say, given it's a product focus conference, you are going to see a new chip launch, a variation of Blackwell. And look, everyone still feels the market is undersupplied when it comes to GPUs. All the hyperscalers have raised their capex for this year. On the supply side, your TSMC and Micron have said they expect doubling of AI revenue. So all that, I think, is supportive of demand for NVIDIA. The only wild card is everyone is talking about the plateauing of pre-training and the fact that focus is shifting to reasoning and inference time compute.
That's a DeepSeek result.
That's the DeepSeek result. And that, to me, is the biggest sort of concern around NVIDIA as a stock, what it means for its growth rate, because in the end, this is a cyclical market. And everyone recognizes, even though there's a long CapEx cycle and it's typically lumpy, there will be an air pocket sometime, and I think they will have to answer it.
It's interesting. I learned so much about this at the conference that you and Anurag put on here a few months ago, and I talked to the CEO of Samba Nova at that conference, and they were making the same point pre-DeepSeek, right?
Yeah.
Not everybody needs to spend trillions of dollars to build their own large language model. It's the inference that counts. Are we seeing those stocks, though, do well now in the wake of that?
Well, so think of, who is the biggest inference player out there? It's still NVIDIA. So that's the thing, right? NVIDIA dominates both the training side as well as the inferencing side. The question is, if everyone was building, a 100,000 GPU cluster and Grok did that, Meta is talking about, acquiring a campus where they can put 200,000 GPUs together. That supports NVIDIA demands more than, the inference side where you will have multiple data centers, but not the same scale. And that's the big difference is, are you going to see fragmented supply when it comes to the GPUs, or are you going to see bigger and bigger clusters? I mean, there were even talks about a 1 million GPU cluster.
Wow.
That is very supportive of NVIDIA
Have you
demand.
ever looked up yourself on Grok?
No, I haven't. I just like to say the word Grok.
It'll make your morning. It's very kind to the people who are looking up some information.
I'll check it out.
Yeah, it's a nice ego boost. Anyways, you think about how much has sold off in the fray this year. One thing that Morgan Stanley points out is how much other companies can potentially benefit. Humanoid companies can benefit off the heels of this week. I want to pull out what we saw from Morgan Stanley's analysts who said that they believe the challenges facing Tesla's current business in particular are widely reported and well known, while the opportunities in the future business are potentially greatly underestimated. What role does NVIDIA play for the humanoids?
Absolutely. I mean, they've been very good about staying ahead in terms of the new markets that have come about. And I do think they will talk about humanoids as a growth market. Our view is, and we are holding another conference, the one that Matt was referring to on April 2nd, where we'll talk about humanoids as a potential addressable market. But look, you need a lot of precision when it comes to driving these humanoids using AI. AI still hallucinates. So the fact that, you're talking about driving a humanoid with an AI model that can hallucinate, I don't think it's ready for prime time yet, but we'll find out more from Jensen when he gives his keynote at NVIDIA.
RoboCop. Have you seen RoboCop?
I have not seen RoboCop.
Awesome.
I'm more comfortable with like a humanoid vacuum than I am a humanoid car at this point, but
by the way, you have
see.
a conference on April 2nd. I don't believe I've been invited yet.
You are invited, Matt. You will be hosting a couple of sessions for sure.
Okay, I hope so.
Things in mind for you more than you realize.
Mandeep, thanks so much for joining us. Mandeep Singh there from Bloomberg Intelligence. Now let's get a quick check on what's going on in futures this morning. Take a look at the back and forth, the bouncing up and down that we've seen on the S&P. Right now, completely unchanged. So Mr. Market hasn't made up his mind yet. NASDAQ futures are up 0.1%, and I suspect that is on optimism for the GTC, right? GPU Technology Conference being held by NVIDIA. That's going to go on all week, so we could get news out of it at any moment. We're also watching defense stocks right now. Lockheed Martin could hit a choppy patch as Canada's U.S. trade tiff prompts a review of the F-35 fighter deal, right? It's agreed to buy 88 F-35 Lightning jets. And now, over the weekend, the defense minister said that Canada, as well as Portugal, they're going to look at maybe changing that contract around a little bit, which could be a concern.
Yeah, very interesting to watch what's going on there. But I also want to pull apart and look at some things that are happening in the consumer world as well. I'm looking at a firm because they are moving lower, because Walmart partnered with Klarna for buy now, pay later. Matt, this is an extraordinarily heated space. A firm is not down as much as it was a little earlier, but it is still down more than 6% pre-market. You are seeing others also fluctuate off of different reasons, but a firm, remember, has a market value of almost $15 billion. That is what Klarna is looking to seek in an IPO, trying to raise $1 billion. They're out talking to investors right now. It's another data point they can give them. The reason we're also looking at SoFi, of course, is they also are in now the lending business in a big way to consumers. They partnered with Wyndham this morning. It's all kind of very tied together when you think about these financing businesses. People are watching them very closely. Ally is actually down because of that auto sales figure that we were talking about a little earlier this morning.
Right. The headline, though, is a firm gets replaced by Klarna.
It's
not just that Klarna partners up with Walmart, like, oh, they got a new JV. They're displacing a firm, and that's a big move for the stock. Still ahead, RBC cuts its S&P 500 year-end target on growth risks. Lori Calvasina joins us at the desk in just a few minutes to talk about what's going on with her targets and if we could see a sustained bounce now. Plus, President Trump and Putin are set to discuss ending the war in Ukraine tomorrow. More on that next. This is Open Interest. Let's get now to high interest. Look at what's making headlines around the world. The OECD predicts the pace of global expansion will slow to 3.1% this year. The Paris-based club of 38 rich countries cut its outlook for global growth, pointing to trade barriers and uncertainty as the reason for the drag. The Kremlin has confirmed that Russian President Vladimir Putin is due to speak with President Trump tomorrow. The U.S. is pushing for a 30-day ceasefire in the war in Ukraine. Trump told reporters aboard Air Force One on Sunday there's a very good chance for a deal. Those are his words. And the White House is defending its move to expel hundreds of alleged members of a Venezuelan gang to El Salvador for imprisonment. A federal judge ordered a halt to some of those deportations. White House Press Secretary Carolyn Leavitt said that the order does not conflict with the administration's actions. Sonali?
And Matt, we're going to look at some of the sectors that have been impacted by what is going on under the market today. We're looking deeper into chip stocks, of course. We're waiting for that big event from NVIDIA. Listening to CEO Jensen Huang on Wednesday, you are seeing NVIDIA on the move this morning prior to really anything happening with that event. Tesla, though, still down. We've been talking about it. Morgan Stanley seeing a potential for some change there. Our own Mandeep Singh at Bloomberg Intelligence sees a long way to go, though, in terms of gains for Tesla, in terms of humanoid activity based on what NVIDIA has got going on.
Yeah, and Baidu out with a new chatbot over the weekend called Ernie. Ernie X1 is apparently better at explaining its reasoning to users. We're looking at retailers and auto retailers, especially because of the retail sales number that came out. You had a little bit of a disappointment for auto sales, but here are the big retail movers pre-market. Walmart down right now, as well as Costco and Home Depot. Amazon putting up gains. I think really the defense sector is one of the most interesting to watch today because of that move by a Canadian minister that over the weekend joining Portugal Portugal and saying they're going to reevaluate their contract to buy F-35s. That affects a slew of companies from Lockheed Martin to Raytheon to Northrop Grumman. I mean, there's like 10 General Electric companies working on this project. So if they pull out of that.
I think that is interesting. You're talking about Canada making this move. The question of the push-pull between international countries here pulling into their defense spending while the U.S. has been talking about cutting down some of their defense spending is still an uncertain outcome here, I think, for a lot of these folks.
Yeah, absolutely. Let's get a quick check on futures ahead of the opening bell coming up in just 12 minutes time. We see little change in terms of S&P futures right now, down about 0.04% after that correction, and then a pretty sweet recovery on Friday. NASDAQ futures are gaining, but also very little change right now, so not a lot of movement ahead of the opening bell. And we come back, Lori Calvasina joins us, RBC Capital Markets head of U.S. equity strategy. She's cut her outlook. We'll ask her if she thinks we could see a sustained rally after this. This is Bloomberg. Quick check on futures ahead of the opening bell. We just got about 9 minutes to go. S&P futures, NASDAQ futures, Russell futures, little change, but all showing red arrows at the moment. Let's talk about this with Lori Calvasina, RBC Capital Markets head of U.S. equity strategy. RBC, they just lowered their year-end target for the S&P 500 to 6,200 from 6,600. So, Lori, you're still, positive from here, right? You just don't think we're going to get as much bang as you previously had thought. Why is that?
So, this was honestly triggered last week. Our economic and rate strategy team updated their forecast, and this is something they do on a pretty regular cadence. But their GDP number went from 2% down to 1.6%, and that triggers a change on one of the models that we use to come up with the S&P forecast. So we have 5 different models. It's very quantitative. My clients joke I'm all about the math, less about the story. But one of those models, and we had signaled this as something we were struggling with in the year ahead outlook, that when you are in the 2 to 3% GDP range, and consensus has been around 2-3, our team was previously right at 2, it's a good environment for the stock market, right? And we all had this idea that the vibes were going to be strong and we had a more business-friendly political backdrop. But they took the number down to 1.6, and that's right in the middle of this kind of 1 to 2% range. That is a very tricky environment for the stock market. You're down more often than up, and your average gain is about, actually it's a decline of about minus 3.4%. So that was one of the changes that flowed through. There were also some changes to our valuation model, which is based on PCE, 10-year yields and Fed funds. And so we had to make some adjustments there. We also made some adjustments to our earnings number, which went from 271 to 264. And a lot of that was the GDP, as well as us reining in our own margin assumptions. So it kind of all fit together. And look, I'll tell you, Matt, that 6,200 is predicated on the idea that this is about the low, right? This sort of 10% type number. We're not going to get too much worse from that. My conviction in that is not huge. We have to sort of watch the market in here. I see some things on the sentiment side that say this could be a bottom, but I see other things that say maybe we need to go more. So we're just going to have to watch the market a little bit in here.
Not to be a Debbie Downer on a Monday morning, but I think
you can be. The sentiment is very bad,
it's very bad, and I think privately people say worse things that they're saying publicly, right? So what is...
That would be a concern because they're saying very bad things publicly. Look at the AAII bullish bearish. Joe, you have that. Pull up the AAII chart and look how bearish the market is publicly. The street is publicly.
I can't tell
the
you
worst since 2022.
How many people wish they said they sold when I was down in Miami for future proof this weekend. Those are RIAs. These are people managing other portfolio stocks. What is the downside risk?
So look, we've got this new table in the report, and we've been talking about this as a framework I've used for years, but we call it like the 4 tiers of fear. And I know that's a very sort of scary, sort of label to put on it, but it has been coming up, right? When people have been saying, what is this that we're dealing with? What does this look like? 5 to 10% is tier 1. Garden variety pullback. We're at the bottom. So what's the next tier of fear? I think it's what I call tier 2, the growth scares, which is a 14 to 20% drawdown. And that's, if that happens, that takes the S&P to sort of like a 4,900, 5,300 roughly. That idea is based on the post-GFC pre-COVID growth scares, which were all in that range. So 2010, 2011, 15, 16 industrial recession. and the 2018 trade war, which was under Trump's first term. That was a 20% drawdown peak to trough, and a 6% decline on the year. So that's kind of the next tier of fear. Otherwise, it's recession, 25 to 33%. Crisis, you lose 50% of the market value. I don't think we're in tier 3 or 4, but I do think the risks of tier 2 have significantly risen. And if we don't hold around this 10% mark, I think that's where we're going.
Well, and Sonali on our call this morning was talking about the damage that's been done technically, right? As we broke through 200-day moving averages on, I mean, every major U.S. index, right? And I think it's even worse for the Russell 2000, like down below its 200-week moving average. Yeah. What kind of value do you give to technical analysis, Lori?
So I think it's important the traders watch it. It informs sentiment. And, you know, you go back to AAII, I have this whole list of things I look at when you're in really bad markets to gauge whether fear has gone too far. And we have to watch that kind of data because we are all subject to that same kind of fear. AAII is technically sending you a buy signal, right? It is so bad. It's actually at GFC lows as well. It does tend to get stuck there for a little while, but on a back test, 9 months later, we should be up about 10%. Things like CFTC, the weekly positioning data, that's early innings of declining. We only have that data through last Tuesday. We'll see where we are this coming Friday, but you've got things like that that need to catch down, and I think that's probably the sentiment you're picking up. I'll also tell you, Sonali, though, I was at a dinner last week, and, you know, I was talking to a bunch of people who wanted to buy the dip. So, you know, and still saying there was a Trump put, and I sort of joked, and I said, well, you know, we're not really going to bottom until nobody's saying there's a Trump put. Yeah. You know, so we're dealing with those kinds of dynamics.
Yeah, Lori, stick with us. Perhaps just as much of an issue is there a Fed put anymore, as long as people are looking for a Fed and Trump put. That is Lori Calvasina of RBC. She's sticking with us, and we are less than 4 minutes to the opening bell. It's a tough open. It's a tough tape out there. Stick with us. We'll bring you everything you need to know at the market open. This is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We are seeing futures that are bouncing back and forth between gains and losses this morning. Right now, we're looking at all red arrows, but they're very slight, right? 0.07% down on S&P futures. The same is true on NASDAQ futures. Russell 2000 futures moving a little bit lower. And as we were talking about before, they've been hit the hardest in terms of technical damage. You hear the opening bell on the New York Stock Exchange. British American Tobacco and R.J. Reynolds celebrating 150 years of making smokes. They're the Camel guys there. Down on the NASDAQ market site, Yahoo Sports has some kind of March Madness like bracket challenge, but it doesn't matter because Bloomberg, we have our own bracket challenge. If you type in BRKT GO, then you can enter your own bracket on the Bloomberg and compete against the smartest minds on Wall Street. In terms of what's going on in the indexes right now, let's take a look at the live trade a few seconds after the kickoff. You can see things are settling lower. So S&P 500 as well as NASDAQ 100 futures down about 0.1%. I am telling you, wait this week to see what we get out of that NVIDIA conference, because any huge announcements by Jensen Huang could drive up the big tech stock, could drive up the Mag 7, and that would pull up, obviously, these two indexes with it. The Russell 2000 index, the small caps, lower quality stocks doing worse, right? Down 0.2%. We'll continue to keep an eye on that, but this is really where growth scare hurts. This is really where rates hurt. And I don't know how much they're going to be helped by a big AI conference. In terms of the stocks to watch, individual stocks, NVIDIA obviously is a huge focus, the second or third biggest stock in the world, depending on Microsoft's market cap. Right now, NVIDIA gaining, but only about 0.5% to 122.17. That conference this week really could be a catalyst, as Sonali was pointing out earlier, for Tesla. It could be a catalyst for Micron, the memory maker. It could be a catalyst for Baidu with their new chatbot, Ernie X1 out. So NVIDIA is one, Sonali, that we're watching very closely.
But I think the operative word of what you had there is could. This is such a market built on hope, and one place it could help, to your point here, is Tesla. It's now almost wiping out all of its gains from Friday Friday. We have it down more than 3.6%, fluctuating a bit at the market open. Remember, Matt, what's fascinating, Tesla at $240 is about $20 below its one-year average. So analysts like those at Morgan Stanley are believing that what NVIDIA says about the humanoid potential of what it does in AI could impact Tesla. Could be a while till we see it, but of course, this is off its lows for a year, but meaningfully lower than its average.
Yeah, let's get back right now to Lori Calvasina to talk a little bit about the broader market, and maybe we can bring in some of those threads, right? We had retail sales that were kind of disappointing. We have hope for AI, but that's like a B2B play. Lori Calvasina from RBC Capital Markets. You have cut, as we were talking about, your target, but still 6,200, so still a ways up from here. What drives us there? Is the big tech play? Is the AI conference? Is, NVIDIA charging $1 million a chip? Is that going to help?
I think it's that we've simply got to get to the other side of this moment that we're stuck in right now. I think if we look back historically, when we have sort of these GDP blips in a given quarter, sometimes those lead to growth scares and sometimes they don't, right? And so I think it's really just kind of the relief on the other side. And, we're all talking about the retail sales data this morning. I haven't really had a chance to dig into it too deeply, but what I'm seeing based on how the headlines are fluctuating is that the market is trying to figure this out. And I think that's what it ultimately comes down to, right? Are we just going through a sentiment shock, or is this sentiment shock really creating some lasting damage with tails? And we just don't know that yet. We've got to get this hard data in and parse it and go through it, and we've got to get a little bit of duration on this hard data as well. I think, frankly, we need to reset earnings. I don't think people are going to trust anything I say on valuation until we get a sense that there's a little bit more certainty into earnings outlooks.
It's interesting. When you look at the sectors for the year, I think I'm just stunned by how much consumer discretionary has lagged the broader market. I get it, fine. A lot of that is things like Tesla and Amazon as well. But with retail sales the way they are and a lot more consumer sentiment data ahead, even if you have investors parsing, even home sales now to see how the retail sector is doing, how much more pain is there and what does it mean for the broader market?
So look, I'll tell you, Sonali, two thoughts on that is I spent some time last week going through conference transcripts and earnings call transcripts of retailers and other consumer-related sectors across the Russell 3000. So not just the big cap companies, but the small cap companies. And I was stunned how many things seem to be hitting the consumer right now. It's not just tariffs and policy uncertainty, weather, fires, interest rates, inflation, the flu. I don't think that's gotten enough airtime in the media, just how nasty this flu season has been. What that means, though, is, it is going to take a lot to sort of repair that damage, right? There's a lot of different fronts that have to be attacked. I think the other thing, too, frankly, is if you look at the University of Michigan data, we're close to recession lows. And if you want to sort of back up a step and maybe look at small businesses, there's a little bit of a conundrum in that data because you've got sentiment and optimism and economic optimism that's been, kind of taken a hit, right, but is up around all-time highs. So it's telling you there's froth that needs to come out. But then uncertainty is almost back to peak. So which is it? Are people too scared or are people too optimistic? It's a really confusing moment for the consumer right now.
Speaking of the consumer, we are almost exactly 1 month from big bank earnings, the unofficial start to earnings season. And if the consumer is weakening, you have to wonder how that really rolls through into those first set of earnings results. Can you believe it? I'm already looking.
Sonali is already thinking about big bank earnings.
How could you not?
And I'm like, at least we have a month until big bank earnings.
I love that.
How are they going to do, Lori? If you have this kind of concern about the consumer, you have this much concern about, you mentioned small businesses, right?
Yeah.
The NFIB, commitment to expansion is very low.
Yeah.
So that can't be good.
Well, and their commitment to raise prices is moving up, right?
Yeah.
So you're seeing that. Look, I'll tell you, our financials conference, the bank sounded calm, cool, and collected. They acknowledged, I think, especially on day 2 of our conference, that there was a pause that they were seeing in terms of activity. I think, one of the gentlemen who presented said, we all just need to turn the news off. I know that's not good for you guys, but, just sort of speak into the idea, right, of the news flow and how that was impacting activity.
But remember when Jamie Dimon said, even bankers who didn't vote for Donald Trump are dancing in the streets right now? They're probably not dancing as much this year.
Well, certainly the M&A activity, right, has been depressed, and that directly relates to confidence. And if you even look at that Business Roundtable survey last week, right, I think the headlines were all, sort of it's resilient, but it went down a little bit versus the last quarter, and it's been in a pretty weak recovery off the lows. So I don't think anybody's dancing right now.
You know, Lori, not to make this about bonds, but to the point that you were making earlier, you have a 2-year yield that was sustainably below 4%. Pretty much for the last 2.5 weeks. Yeah. You are now well above 4% once again on that 2-year, and I'm wondering at what point do these kind of sticky higher interest rates matter? You're already perhaps seeing it in the Russell 2000. Where else does it count?
So I've been more focused on the 10-year yield, and I know obviously, you know, that's where a lot of the conversation has been happening, trying to take that yield lower. What I see on my data is that makes sense. I mean, it's really the thing that matters, frankly, more than the Fed funds rate. If I'm looking at interest expense, or if I'm, you know, looking at or if I'm looking at debt levels over time or effective interest rates that companies are paying. I will tell you in my earnings forecast, I modeled in the 4.2% number that our team is highlighting for the end of the year, but they also have it going lower in the interim before coming back up. So that all flowed through into my model. So I have interest expense coming way down in that earnings calculation for this year, and that's helping my new number. Unfortunately, it's not offsetting the weaker GDP reads. It's not offsetting my more pessimistic margin assumptions, but it is helping.
Lori, we thank you so much for setting the stage. Of course, it's a complicated market and a lot of negative sentiment out there, but we take a measured tone here.
I love it when Lori goes on Nathan Hager's radio show in the morning before she comes on with us. So I get a little bit of a preview, and it makes things so great.
But we have now an outline of every tier of fear.
Tiers for fears.
Tiers for fear. We're going to
be
keeping a close eye on those tiers. You know, we also want to talk about some things moving under the radar because Intel is on a tear, Matt. If you take a look at it, it is a very warm reception for the incoming CEO, Lip-Bu Tan. He has been signaling that he's going to stick with the plan for its foundry business to make chips for other companies. The market seems to like it. You are seeing Intel now up more than 5.7%. It was up more than 6% a little earlier.
Yeah, I think the market likes the idea that he's going to cut some jobs as well. So restructuring the company's approach to AI.
For Ohio.
Well, they haven't gone there quite yet, but you're right. It's a very difficult story for the great state of Ohio. At least we won the national championship in football. This is Bloomberg. This is Open Interest.
This is Open Interest, and it's time now for our top calls. Some of the analyst action in focus this morning. First up, we're watching JP Morgan upgrading Norwegian Cruise Lines to overweight after the stock posted its biggest gains in a month on Friday. The Wall Street Journal says it's wave season for bookings. They need that boost. A lot of uncertainty around the cruise lines, up now 3.8%. Next up, we're watching DocuSign getting an upgrade from William Blair. The analyst is bullish on the new product cycle's ability to re-accelerate growth back to double digits. Also on the rise, you're watching DocuSign up almost 2.3%. And finally, we're watching MoffettNathanson raising Netflix to a buy from neutral. And the analyst is saying that the company's ability to better monetize is underappreciated. Netflix up 4.2%. I've been watching a lot of that lately, Matt.
18 minutes into the trade, what's going on with the major averages? You can see green arrows now across the screen. The S&P 500 up 0.4%. The NASDAQ 100 gaining as well right now, and we're looking at a 1/3% gain. Russell 2000 shares doing twice as well as the rest of the indexes, major indexes there. I'm looking to see who the biggest points gainers are, and Netflix is right up there. Maybe because of the Goldie Hawn show. And Berkshire Hathaway.
Goldie Hawn's daughter.
Her daughter, Kate Hudson,
yes.
Right? And Berkshire Hathaway, look, they have so much cash, right?
Yeah.
If there is somebody out there that could buy the dip in size, Warren Buffett has to be the man.
Right, and also if you have the 2-year rising to 4.05%, as we saw this morning, then cash feels good. You know, I would also say, though, if you look under the hood of the S&P 500, the sectors that are gaining are quite defensive still. You have healthcare, energy, utilities, consumer staples, real estate. You're seeing green on the screen, but it doesn't scream confident.
Yeah, because the biggest losers are Nvidia, right? Tesla, Amazon, Broadcom. So those big tech stocks that should be getting a boost from this GTC are not. Coming up, the OECD says Trump's aggressive trade policies have abruptly set the world onto a path of slower growth. More on that outlook and how Wall Street is coping. This is Open Interest.
while cyclicality has suffered domestically, cyclicality is alive and well in Europe. It's alive and well in Asia. The cyclicals in Europe continue to outperform. The cyclicals in Asia continue to outperform. So, kind of our big call this year was cyclicality isn't extinguished domestically. It's just migrating globally.
That's Strategists partner Chris Verone on the show last week. We're going to talk also about how Wall Street strategists are coping with what's going on, because you're looking also now at all the gains that are being seen this morning. Very volatile. You're looking at the NASDAQ 100 that was up just a few moments ago, now erasing a lot of its gains. It's not quite at session lows on the day, but it is trying to regain that bid. Across Wall Street, you're looking at strategists trying to cope with this dynamic. Are we at the low? Are we not? And one of the biggest bulls on Wall Street, Ed Yardeni, is seeing some pressure under the surface. We're going to bring in Bloomberg's Michael Masika to talk more about what's going on. I was really struck over the weekend by Yardeni's note, because he said that he's calling it now the Trump thump. This idea that the best trade has been to short the S&P 500 since February, yet you're looking at a lot of investors now without even the firepower to go short. He says that they're not convinced that the correction is over despite the rally on Friday, and that there's extremely bearish sentiment readings, which tend to be bullish from a contrarian perspective, but he doesn't know if this time is true. So when you're looking across the street, Michael, ultimately, how many people are willing to dive into what has been extremely negative sentiment relative to what we've had in the past year?
Well, that's a good question. To be perfectly honest with you, it doesn't seem that the buy the dip moment that we expect has happened yet. There's been some deep buying. Some investors are looking to buy. Last week, a lot of hedge funds started to buy that little dips in US equities. But it lacks conviction. Lacks convictions because volatility remains very high, because the trade uncertainty is very high as well. We don't know what's going to happen until the first tariff are going to be put in place in April. So all that is keeping investors really on their toes and not willing to dig in just yet.
You know, I was reading Mike Wilson's note over the weekend, and he points out we could see a little rally here. He thinks we started one at Thursday when we hit 55.05, but he doesn't see it really as sustainable. He says, we believe that earnings revisions is the most important variable, and it will take a few quarters for this factor to resume a positive uptrend. So I went and looked at the Citigroup earnings revisions index, and it does not look very good, Michael. I mean, down, down, down. When we came into this year, I was hearing 15% earnings growth, and now the average on the S&P is for 9%. How bad is it?
That's right. It's been like downgraded and degraded again, but it hasn't really fed into earning estimates for the year, or just barely. So we might have a lot more earnings downgrade, and it might just like be shown at an index level a bit later on this year. What's going on is like you have now a lot of economic data in the US that is rolling over. Consumer confidence is a bit down. The job market is shaky. You don't expect the Fed to act anytime soon.
Yeah.
So we'll see what's happening with the US economic growth, but it's likely to be downgraded this year.
Yeah.
And earnings will follow as well. And so I think until we start seeing some of those, and some of those being priced in the market, then there is a big risk that we see some more drawdown.
Michael, great to have you on the show. Michael Masika there out of London. Just want to point out quickly, Sonali, that if I'll bring up the ECAN again, right? ECAN Go on the Bloomberg terminal, because he mentions economic growth getting downgraded. And ECAN now has Atlanta Now, the Atlanta Fed GDP Now forecast. You can see how much lower it's gone. And if you click into that blue box, which is exports, the real problem is imports. They've just dragged on tariff concern. Coming up in the next hour, Meera Pandit joins us from JP Morgan Asset Management. We We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today. And coming up, Fed Chair Powell faces a tricky task this week of assuring investors the economy remains on solid footing. Retail data out this morning adding to concerns of a pullback in consumer spending. And NVIDIA investors hope a keynote speech from CEO Jensen Huang at the chip giant's much anticipated AI conference this week will give the stock some momentum. Plus, pushing for an end to the war. President Trump says he'll speak with President Putin tomorrow, saying progress is being made.
All right, let's get a check right now what's going on in the markets just a half hour into the trade and looking better than you might have expected if you took a look at futures this morning that were bouncing back and forth between red and green. Pretty solidly up on the S&P 500, 0.4% at 56.61, 56.62. Don't forget that we hit 55.05 on Thursday. That was Mike Wilson's level, and he called for a rally after that, at least for a while. NASDAQ 100 gaining as well, even without the support of the gigantic mega cap stocks that are on the downside, and then the 10-year yield holding right now at Sonali, you basically called this 430 level, right? You said this is like the new level.
Right, this is the new level. If we break too much in or out of it, you have to worry again about growth concerns to a greater degree. If we break too much above it, then you're worried about inflation and fiscal deficits. Neither of those are good things.
All right. Great that we got that cleared up. Let's bring in Meera Pandit now, JP Morgan Asset Management, Global Market Strategist. Meera, great to have you here. I guess a growth scare is really the concern for this market, right? I mean, after we saw the OECD revisions, as we look at the Atlanta Fed GDP Now cast, the concern is that we don't get, 2% or more GDP growth. What do you think?
What we do need to be considerate of is starting points. Starting points matter. When we think about GDP over the last 4 years, it's been growing at an above-trend pace. 9 out of the last 10 quarters have been at an above-trend pace. If we think about profits, we're coming into another strong expectation of profit years. Profit growth of 12%. Even if we see half of that, and we're likely to see some degree of downward revisions, that would still be in line with a normal profit growth year. But it works both ways. We also entered the year with valuations very much extended. So really this sell-off was a question of when, not if, to see a pullback at some point this year. And the tariffs, the uncertainty, that's the why.
Now, one question I have, in addition to levels, you had Mike Wilson calling for 5,500 as a low. We've had other strategists call as low as 5,200. With that kind of uncertainty.
Leaving Kolonovich out, right?
Yeah.
Because he said the 4,000s.
Oh, right. Yes, that's a whole other thing. But, if you think about not only the level, but the time, there's a sense that maybe April could start to clear up some of this uncertainty, but there are others who believe it could take a lot longer, maybe the second half of the year. When do you think the clouds start to clear?
Let's put the volatility in context first. On average, we see about a 14% sell-off every single year. So what we're seeing so far this year is in line with averages. We've seen less volatility in the last 2 years, so we've just been a little bit out of practice. And 75% of the time, the market does end up positive to end the calendar year. So I do think that price targets that call for a higher S&P by the end of the year are still reasonable. But I think we need to see 4 things when we think about that time frame. One would be valuations coming down a bit more. The overall index is still about 20% more expensive than its long-term averages. Even if you take out the 10 best stocks or the largest stocks, they're still about 13% more expensive. Tied to that is earnings. See a bit more of an earnings downward revision from the heights we are today. That's going to have a bit of a valuation impact, so you're probably going to have to see prices move even a little bit lower. Third would be continuing to see somewhat more Goldilocks data. Jobs, inflation, retail sales has been reasonably solid, although moderating. And then lastly, it's not that we need to see tariffs go away, but starting to see maybe a little bit of consolidation around tariff announcements or some more of a strategic direction that will help us rule out some of these second-order impacts to the economy.
Well,
and
winning,
growth.
right? I mean, what if we start to see Trump's tariff war win? For example, if the EU were to back down on its auto tariffs, dairy tariffs, meat tariffs, he already got Doug Ford to back down on his electricity surcharge. If you see that, and then you get tax cuts or, tax cut extension and real deregulation, if you get M&A starting to take off, we've all been waiting for it and it hasn't really happened. Are those things a catalyst?
That certainly presents the upside case and a pretty compelling one. Let's see how all of that does play out, because it's clear that with the deregulatory agenda, there's a bit of a push and a pull. It's not that all of the antitrust efforts towards tech have been taken off full sail. We still haven't seen as much movement on that agenda yet. And with the tax cuts, we're probably going to see an extension of the Tax Cuts and Jobs Act, but hard to put a lot more on that when we think about debt and deficits as a concern and how the bond market has been reacting to debt and deficits as of the last 6 months or so. But nonetheless, it can clear some of that uncertainty, and in and of itself, that is a catalyst.
You know, one element of uncertainty, too, is when you look at what we saw out of the retail data this morning, the consumer picture overall, how the consumer contributes to growth, especially when the muddiness of the U.S. layoffs at federal agencies is not really seen through the data in full yet. So how much uncertainty is there, and what role does the consumer play in this market?
Right now, when we think about our forecast for this quarter, where we're seeing some of the least weakness is still around the consumer because of the very strong base, where that consumption has been pretty solid. And if you do look at measures of confidence relative to what consumers do, it's not always a one-to-one relationship. I mean, the pandemic is a great example where we saw 20 million people lose their jobs in a month, and yet people continued to spend throughout the pandemic. Now, there was stimulus there were other factors at play, but the consumer in the U.S. is often pretty resilient, so those consumer confidence measures may not tell us as much about that growth scare. What is interesting about some of those consumer sentiment measures, though, when we think about it from a market's perspective, is right now consumer sentiment is not so far away from where we were in 2011 during the debt downgrade, in 2008 during the financial crisis. And when we get to those kind of troughs in sentiment, what we tend to see is a pretty big market response a year later. So if you look at the peaks in sentiment over the last couple of decades, on average, 12 months later, you would have gotten a 3.5% return on the S&P 500. If you look at the troughs in sentiment, on average, you get about a 24% return. Again, valuations matter. We're not expecting another 20+% year, but there is some scope for recovery.
Meera, we thank you so much for your time this morning. That is, of course, we're looking for the measured view in this market because a lot of tough sentiment out there, but people are looking for that opportunity to buy the dip. Now, speaking of buying and selling, we're going to get a look under the hood with stocks moving this hour with Bloomberg's Isabel Lee. And, of course, we're doing my favorite story first when it comes to M&A. We're looking at Pepsi announcing a deal. We cover those beverage stocks a lot on this program, don't we?
So Pepsi is interesting because it's confirming its purchase of Poppi, which is a prebiotic soda brand, for a net price of $1.65 billion. So the total deal is $1.95 billion. It includes around $300 million of anticipated cash benefits. And the deal includes a potential earnout consideration. Basically, this incentivizes sellers to still stay on board and still help with the goals and the milestones of the company. So recall that Pepsi has tried to launch its own brand called Soul Boost, but it wasn't really successful, so I guess they turned to just acquire. Well, now they have.
Yeah.
Poppi. And the so-called functional soda category is gaining traction. We have the likes of Fresh Direct CEO saying it's on fire. I do the quotes because he really said it. So it's really an interesting field because imagine you're drinking soda, but it has fiber and prebiotics. Would you try it?
I had been a big Poppi consumer.
Oh, yeah, you have?
No, see, Sonali will drink any new beverage, right? She's all about it.
Yeah.
I like just drinking water.
You know, I'll get you hooked. You have no idea. If the kombucha really takes off in the morning, I drink it most in the morning. You know, it's interesting. Stock is up. I think that bodes well for M&A as you're talking about. There's another stock we're looking at as well that is not doing as pretty today.
Really not doing well. It's like
crushed.
down, 13%, because it's dethroned by Klarna. So Klarna on Monday announced a partnership with OnePay, that's a Walmart-backed firm, to offer buy now, pay later to U.S. shoppers. So OnePay is a finance app, and Klarna will become the official exclusive option once it rolls out this year. And you can see shares in the firm really edging lower by 14%. And this is a big deal. We have the CEO of Klarna saying that this is a game changer because this comes ahead of their IPO, and it comes ahead of their really big financial earnings last year. And the deal really gives Klarna access to Walmart's millions of customers.
It does not get much better. I mean, if you're a buy now, pay later app about to IPO and you make a deal with the biggest retailer in the world,
The
That's
only
gold.
thing you could have that's better is exclusivity with Amazon, one would argue. But to your point here, Walmart is the giant in the room. And honestly, with Klarna's IPO expected early April, huge rivalry to watch, Matt.
And they're Stockholm founded, and their company revenue climbed 24% last year. So who knows what that will be this year.
You are also watching Isabel Deckers. I was interested in that because going into today, it was the worst performer on the S&P 500.
By the way, I always think this is the company that makes porches, you know, like decks.
Like decks?
Okay.
That's actually Trex. I
did
confuse
too.
them, but this is not
No. They're
like
the
a
maker
paneling.
of Hoka and Uggs. So
They
they're
make-
the worst
Favorite
performer
for me and
today.
Katie.
You like
Yes,
Uggs?
I wish Katie would.
Katie
love
wears
Uggs.
Hoka shoes, and you wear Uggs.
I do.
No.
Not for me.
Yeah, me too. But others do, and that's great. So they've been
Ouch.
really having a tough time. And actually, if you look at the S&P 500 MEMB, M-E-M-B, they're down by 13.60%. Not Hoka, but the S&P Footwear Index. So can you believe it? So I think consumer discretionary is just really struggling because inflation is high. Consumers in general are struggling. But we have Hoka as the crowning glory of the company because we have a Bloomberg Intelligence note saying that there's plenty of room for growth and that Hoka could become a $2 billion brand in fiscal 2025. So one more thing, I also cover index rebalancings, and outdoor deckers was added to the S&P last March, actually.
You say
So if there
outdoor
were-
Deckers?
Deckers outdoors.
Deckers outdoors.
Deckers outdoors.
That's why I think it's, yeah, okay.
Anyway, they're down by more than 20% since they were added.
Brutal.
So bye-bye to the index.
You know they own also Teva, which for me, when I was like
I still wear Teva.
dousing myself in patchouli and bringing my hacky sack to see fish at Denison
Patchouli.
University, I was wearing Teva.
I wear Tevas
sandals,
when
you know?
I go to the beach. Still.
Yeah?
Yeah, maybe I am out of touch, but I don't know. You know what's interesting to
You're
me about
all
that?
in on Deckers outdoors.
I am. I wear a lot of it. But to the point that Isabel was making, a lot of index rebalancing funds got super burned, if you might remember. This is just one example
Reading that on the Bloomberg terminal.
of
Yeah.
exactly why. Isabel, we thank you so much for your time. That is Isabel Lee. We are actually going to talk more about what's going on under the surface of those big Wall Street funds. In particular, we're going to talk about dark pools because they're touting an even more opaque way to trade. We're going to discuss the boom in so-called private rooms.
Private rooms.
Ooh, on Wall Street.
Has a whole new meaning on Wall Street.
That's next. This is Bloomberg.
Let's get out of high interest and look at what's making headlines around the world. U.S. retail sales rose by less than forecast in February. Consumers pulling back on spending on autos, electronics, apparel, and they're eating out less as well. Despite the weak data, equities are rebounding because the spending pullback wasn't as bad as had been expected. And Chinese EV maker BYD has unveiled a new battery system that it says can charge a vehicle nearly as fast as it takes to refuel a regular gasoline-powered car. Based on the test, the company says the system can give nearly 300 miles of range in 5 minutes of charging on its new Han L sedan. BYD ADRs are up nearly 50% this year. And America's most prestigious colleges are rushing to the debt market at the fastest pace on record. Harvard, University of Pennsylvania, Stanford, all crowding to sell bonds, all within the span of weeks. The rush to sell debt is driven by worries over potential changes in tax and funding policies. By the way, Harvard also announced that it is eliminating tuition for students with families that have combined incomes of $200,000 or less. So that's pretty good news, Sonali.
There is a huge sea change in higher ed. Perhaps we'll get to it later because for now it's time for the Wall Street beat. There's a story that is just soaring on the Bloomberg terminal, and that is Wall Street's infamous dark pools. They are getting even darker. It's today's big take. These are private rooms booming by taking off exchange trading platforms and adding another layer of exclusivity. To talk about what's happening under the surface, Bloomberg finance reporter Catherine Doherty. You know, I was stunned by the data that you presented in this story. How have these dark pools gotten so big? These are not brand names. This is not the Goldman Sachs of JP Morgans of the world, although Morgan Stanley is up there. These are names like Intelligent Cross and Blue Ocean and DealerWeb. Who are they? What do they do?
So each of these off-exchange trading venues, they have a flavor of what appeals to individual investment firms, broker-dealers that are trying to figure out where am I going to get my best execution. And this depends on the size of the trade, the speed at which they need to fulfill the trade, and oftentimes who they are filling the trade with. So the introduction of private rooms within alternative trading systems, dark pools, is given investors the ability and the brokers that are executing on behalf of the ability to really figure out where am I going to get the best execution because I know who is in this proverbial room, who is going to be the type of either market maker or broker dealer that is on the other side of my trade. And that gives just a little bit more certainty. Many of the market participants that I spoke to just talked about the fact that when you have the knowledge of who is potentially on the other side, maybe not a name, but the type of player that you're going up against and that you're going to fulfill your trade, that allows you to kind of sit back and know the type of execution, or you can expect the type of execution that you're going to get when the trade is fulfilled.
So what's the problem with private rooms? I feel like if I were a big institution, I might want to use those private rooms for certain advantages. Who's disadvantaged?
So the problems per se that have been coming up is this idea of transparency and the access to liquidity. So these dark pools, they do report their trading, their execution quality, and the volumes are very, very public. However, the volumes within a private room specifically are not broken out. So then that brings up questions of if you just broke out those specific, even by percentage, how much is happening within this private room? How many private rooms exist within these dark pools? These are a lot of questions that got brought up in talking to a lot of the market participants. Even those that use them are saying, you know what, some transparency about that wouldn't hurt, it might even help, because if you think about the access to liquidity on a dark pool, you might only get 70% rather than the 100% that you're expected to be playing around with and to access.
Let's double down on what this means for market liquidity, because really so much of this is a function of so much activity since 2008 moving away from the banks into unregulated markets. Some people say this is a good thing, the banks are constrained. Some people say, well, wait a minute, where's all the activity going? And does it make up, I think this is the most important part, for the lack of liquidity you would get from banks stepping back? How do you know the answer to that?
So these are regulated marketplaces. So I'll just start by saying that. And many of the banks actually access some of these or run. You have Morgan Stanley running 3 dark pools, their own ATSs. These private rooms are operated by smaller broker dealers that the cost to set up either a single dealer platform or their own ATS is not enough.
Alternative trading system.
Alternative trading system. It's not enough to make up for when they're doing the cost, the benefit. It's just too much. And so the private rooms allow them to basically operate in a way their own ATS, but it's within the broader dark pool and an alternative trading system that is an independent alternative trading system that's not operated by one of the big banks. So that's where you're seeing a lot of the move of, instead of the big public lit markets, the exchanges, NASDAQ and NYSE, many of the volumes have been moving. We saw it at the end of last year for the first time surpass 50%, so it's become the majority of trading.
Very interesting stuff and a great story, Cato. I read this last night and I knew it would be a hot one today. Wall Street's private rooms making dark pools even darker, written by Catherine Doherty. Check it out on your Bloomberg terminal or on Bloomberg.com. Still ahead, retailer Forever 21 files for bankruptcy for a second time. They still exist?
I was a big shopper there.
More on that next, and not a surprise from Sonali. This is Bloomberg.
And it's time now for social claimers. The company's making waves this morning. And first up, we're watching U.S. Steel because it says the Justice Department filed a motion to extend the briefing deadlines for a Nippon deal, rescheduling the oral arguments to the week of May 12th. And it will allow the government to complete ongoing discussions with the parties regarding the merger talks that never end. But U.S. Steel is up almost 2% on the news. And up next, Intel shares rising. Reuters reporting that income incoming CEO, Lip-Bu considered significant changes to chip manufacturing methods and AI strategies as well. They're revamping the company's manufacturing operations, and that is one of Tan's core priorities. Markets like it. It's up more than 8.2%. And finally, keeping an eye on mall-related stocks after Guess received a takeout offer, and Forever 21 filed for bankruptcy after years of poor performance. Forever 21 has been battling rising inflation, intense competition in a fast fashion sector. Matt, I used to shop here a lot. This was the place we went to growing up. Forever 21 becomes Forever 25, as Jim Bianco called it online. And it's just one of many consumer companies that have been facing bankruptcies. Express cons among retailers in the past year, making it the largest sector to file for bankruptcies in the last year.
Yeah, there is the pie chart there. BCY Go is a fantastic function on the Bloomberg terminal that you can scroll through to check out all of the bankruptcies and see where they're split up. Consumer discretionary as the biggest, obviously the biggest slice of that pie. Healthcare and then industrials and real estate kind of bringing up the rear there. But very interesting stuff, and we'll see if this increases. Want to quickly get a check on the markets. We are almost an hour into the trading day, and we're still looking at green arrows across the board in terms of the indexes, even though we don't have really an outperformance of the biggest stocks on the S&P. Nvidia holding its GTC this week, and it is taking away 5 points from the S&P 500. Coming up, we'll take a look at the consumer and travel. This is Bloomberg Open Interest. Let's get a look at what's going on in the stock market an hour into the session. We still see green arrows on the S&P 500 up 0.25%. The NASDAQ really unchanged at this point, and that's because you have those big tech stocks down. Nvidia is down. Tesla is down. Amazon is down. Broadcom is down. Meta is down. Google is down. Apple is down. And all of those are the biggest losers on the S&P 500.
Yeah, you walked in this morning, Nvidia had a little bit of a boost. All of that is erased and more. And it's because, of course, that excitement around the Nvidia story this week, that big conference they have, is a show me story. This is a show me market. And we're going to get a look at more stocks that are showing investors something on either direction. With Bloomberg's Denisa Seikova, what are you taking a look at? Netflix was interesting us this morning because of the Mag 7. It's a bright spot.
Yeah, let's start with one winner. That's Netflix. We saw a big upgrade at MoffettNathanson, which predicts 20% gain from here. So the target is 1,100, and that's 4% gain for Netflix today. It comes after a Good Friday, another like 3-4% gain. And it's based on the company's effort to monetize advertising, which is turning out to be quite well. We remember in January, they increased the price for that lower tier that comes with ads, and that's a bright spot where analysts see opportunities for growth. The company is off to a shaky start this year, but last year, obviously, it was up 83%. Subscribers grew another 20 million in the last quarter, and we're over 300 million subscribers. So clearly the business is growing, and there is a lot of optimism around it.
Basically, investors liking Netflix streaming television looking more like normal television where you get ads.
Exactly.
It's, you know what, it was a FANG stock, and it's not a Mag 7 stock.
That is crazy.
It's only a $400 billion market cap.
And especially because if you think about how poorly the Mag 7 has been doing, you're actually watching Netflix up on the year almost 7%.
Yeah. 6.5%.
Looks like weak sauce, but it's better than what you're seeing in most of the Mag 7.
I like that you're starting to use that phrase. DocuSign is... Yeah. I love using the functionality that DocuSign
This is
offers.
the third time I hear this.
Right?
Everyone's so excited about it.
Yeah, but what's the deal with the stock?
Well, they have even more functionality for you. They're launching more AI tools, and we had a big upgrade from William Blair, and now the stock is up. Obviously, Friday we had earnings from them. We had like a 15% jump in the stock, so it's doing quite well. And of course, we're going back to AI, all those tools, simplifying signing agreements. And in the fourth quarter, we saw higher than expected profit and revenue, and boosted by this new artificial intelligence software. And the stock is still down year to date, but of course we're seeing optimism during the...
It's done nothing over the last 5 years. I mean, it's up like 20%.
Yeah, the pandemic times, this was the best year. So
pandemic was a huge jump. It lost all that, and then it's flatlined ever since.
Exactly.
But you know, I was talking to Kyla Scanlon over the weekend, and she says, buy the stocks that you use. So we're back to kind of almost Warren Buffett type value thinking.
That's interesting. You know what Barry Ritholtz always says? Like, if you want to buy a Mac, take that money and buy Apple stock instead.
Yeah, absolutely. Because, you know, we're waiting for the upgrade.
Here's a 5-year of DocuSign, by the way.
Never come. Anyways, you know, let's move on to the Norwegian cruise line shares, too. I'm really interested in this, Anitza, because cruise lines were such a hot trade last year. They were a gangbusters trade coming out of the pandemic. They've been hitting a blockage. Norwegian down more than 20%, but rising today.
Yeah, what we've seen with the whole travel industry is that there has been a lot of losses, and it comes back to that pressure on the high-end consumer and the consumer overall. We're actually seeing some optimism when it comes to Norwegian and a few other cruise lines. It's coming from JP Morgan, and they're upgrading to outperform, and a big part of it is how much it's down, so it's obviously attractive buy opportunity, but they're not seeing that huge hit to demand in 2025, which obviously has been a big concern. Everyone's so worried about the cruise industry. They have similar forecasts about Royal Caribbean, so clearly it's more of a wider industry thing than just the one particular name. Obviously, the target for Norwegian is pretty high. It's 56% upside from here, so quite bullish, obviously coming from a big sell-off. But yeah, we're seeing, obviously, Delta had some warnings about the consumer, so everyone's on edge when it comes to travel, but we're seeing some bright spots.
Yeah, we're going to talk to Helane Becker in a second about the consumer and travel, but I read in the Journal this morning, it's wave season. Whatever that, Spencer Jacob, you know, writes that stock movers thing. He says it's wave season, like there are increasing signs pointing to higher bookings. But if I'm trying to save money, if I'm worried about my job, a growth slowdown, the economy, if I'm worried about the stock market, the very last thing I'm going to do is book a cruise, right?
Yeah, they call it the wealth effect.
Yeah.
Stocks down, you don't want to buy expensive stuff.
But it depends on how much you're getting for it. If you look for a spring break ticket now, just to go to the Caribbean, you're screwed.
You know, that's a really good point, because if you're going to travel anyway, right, if you have to do something and you had some fantastic expensive trip planned, then maybe you say, well, I'll do a cruise instead. You know.
And we do have the perfect person to talk to about
that. Danitza, thank you very much. Danitza Tsakova there, Sonali moving me along as usual to talk with Helane Becker about the travel theme. Last week we found out from airlines that American travelers are booking fewer domestic flights. Helane joins us now from TD Cowen, where she is a senior research analyst. So Helane, what do we know about the consumer right now? We've seen some pretty disappointing confidence numbers out of the University of Michigan, for example. How do you see it coming through in the booking data?
Yeah, so good question. We're seeing that the data is slowing on a year-on-year basis. A year ago, we were seeing traffic on a regular basis being up about 5 or 6%. And now we're seeing it in flat to plus or minus 2 or 3%. So we think that we think 24 was probably the peak, and 25 is shaping up not to be as good a year as the airlines thought it would be just 4 months ago.
So just 4 months ago, I was thinking about what me and Matt were talking about that weakening consumer data that we are seeing. How does that hit the tape when it comes to a lot of these travel companies? Are you seeing people just trade down, or are you starting to see people stop spending?
So it's a combination of both. And I know that's like the typical analyst answer. But if the airlines lower prices to attract demand, hotel companies and car rental companies haven't lowered their prices. And our very good hotel analyst, Kevin Koppelman, was commenting earlier today that they're not seeing any demand weakness. And the hotels are telling him they're not seeing any demand weakness right now. So even if the airlines would lower fares, people are still looking at the total cost of the trip and saying, you know, hotels are really expensive. We have to either trade down there, or we have to figure out a way to save to save costs, and it just doesn't work from a demand perspective for the airlines in that regard. So, we think we're seeing a shift. Corporate travel is starting to come back a little bit as companies are making people come back to office 4 and 5 days a week. So that will offset some of the weakness in leisure travel, and also lower fuel prices will offset some of the weakness on the expense side. So margins, even though we're forecasting they'll come under some pressure, it won't be as ugly as it could have been if fuel prices stayed high.
Helene, I want to ask you to step back and take a look at this industry over time. I was living in Europe for the past 6 years before I moved back here, and we were flying from Berlin to Rome for 20 euros or Berlin to Madrid for 40, and that was how it always was. Incredibly cheap to get around Europe. And that was fantastic. And it makes you okay with the hellishness of flying in economy class, right? Now that I'm back in the U.S., I'm paying much higher prices to travel around the United States of America, and Delta, American Airlines, United, all the same kind of hell in economy, right? For someone who's 6'3", it's just a horribly uncomfortable place to be, and they don't make it any better with the services. Why is it so bad in this country? Is this from deregulation under Carter, or how come the airlines can't give us a better product?
Yeah, that's a good question. So here's the thing. In the big difference between the US and Europe is that Europe has an awful lot of secondary airports that some of the lower cost airlines like EasyJet and Ryanair, Wizz Air, and others make use of. And that enables them to keep their costs lower. In the US, and by the way, that's, as you pointed out, that's about half the market. About half the market in Europe is low-cost airlines versus less than 10% in the US. So it's significantly different. The US doesn't have those secondary airports. Not only that, but we have fewer airlines, to your point. That's certainly going through the past 40 or 50 years since deregulation. And that obviously makes it difficult. Plus the airlines, plus they have very expensive labor contracts. That and fuel are their two largest expenses. So that weighs on expenses. And then the other thing that we see happening with the airlines too is airport costs. Airlines have been talking about this for the past year and a half, in the sense that a lot of airports, LaGuardia comes to mind, JFK, Newark, Chicago, they're undergoing massive build-outs, new terminals. I was in Atlanta over the weekend, and they're building a new terminal in Atlanta at Hartsfield. And when you think about the cost of building these terminals in the billions of dollars, and when you start to figure out what it will cost to move a passenger through the airport, the cost goes from something like $8 or $10 a passenger to $35 plus per passenger. So it's really hard to charge $29 or $39 for a ticket when it costs you $35 just to move the passenger through the airport. And you're not even looking at the direct operating costs, the cost of fuel, the cost of plane, the cost of the flight attendants, the crew, and so on. So I think that's a big difference.
Helane, we thank you so much for joining.
It does answer my question to some extent, but it's just frustrating, that for some reason in this country we have to pay so much more. I mean, sometimes 10x for such a bad experience. If I want, to fly like a normal human being, I've got to shell out thousands for a business ticket. Otherwise, I'm riding like luggage.
And it's interesting.
She's moving me along. We have time.
We're being told to leave. Matt, you're getting me in trouble. Helane, we thank you so much for your time today. And of course, as someone who just got home at 2 in the morning because of airplane delays, I feel you. I was in economy. The girl next to me all night was screaming in my ear about something or another. Anyways, we're going to move on. President Trump is set for talks with his Russian counterpart, Vladimir Putin. Of course, a lot of ramifications on what is going on with the war in Ukraine. We're going to discuss it with Wendy Schiller of Brown University and try to make sense of it all for you. This is Open Interest. Now, the Kremlin has confirmed that Russian President Vladimir Putin is due to speak to President Trump tomorrow. The U.S. is pushing for a 30-day ceasefire in the war in Ukraine. Trump told reporters aboard Air Force One on Sunday that there's a very good chance for a deal. For analysis, we're joined by Wendy Schiller. She's the director of the Taubman Center for American Politics and Policy at Brown University. Now, there's been a lot of turmoil, of course, in the relationship between the Ukraine and the United States. And if you think about the potential for a ceasefire, we have certainly seen hiccups to get to that path before and recently. So what is the uncertainty as we think through these discussions that are ahead between the president and the Russian president?
Well, I mean, I certainly think Putin is always a gamble. You know, I think trusting Putin is a difficult thing with any certainty, but the same thing is true now for Donald Trump. He's shown the world that he can turn on a dime as well. Zelensky's troops have made moves, right? They've withdrawn from some limited Russian territory, and Zelensky has tried to sort of make up a little bit with Trump. But I think Trump has also said to Putin, we'll slap more sanctions on you. We will certainly turn on you as well. Trump wants to be the guy that ends this war. Obama couldn't do it when it first broke out in 2014. Biden couldn't do it. But if Trump can do it, I think he views it as a really important signal of credibility on the world stage. Even if the United States is going to withdraw from some things, you still want to be a player and influential. And I think that's really where Trump is playing both sides, or at least trying to play both sides against each other.
I mean, it would be easy enough if you can just give Vladimir Putin Ukraine and, you know, offer him like a slice of Romania, but that's not really a win, is it? Doesn't he have to get something from the Russians? Doesn't he have to move them out of Ukraine in order for this to be considered a good deal?
I mean, what we've seen so far from the Trump administration is getting something from Ukraine, which is access or part ownership of minerals and natural resources, which Ukraine has a lot of, not only what the United States needs, but what the world needs. You know, Trump is looking for a benefit for the United States, not just to pay back the money that we've spent paying our own defense manufacturers for weapons we ship to Ukraine, which is the bulk of the aid we send to Ukraine, but some stake in Ukraine. And I think if Ukraine is strategic, they have to understand that Trump will stick with you if there's a stake for America in it, for him. I think just pushing Russia out doesn't do much for Trump's motivation. I don't think that's going to make him really go to the mat, but also establishing that Putin can't just go wherever he wants without the United States as a player. It's a projection of power. And Trump likes projection of power when he can see an end line, an end game that he can claim credit for.
Wendy, while we have the United States looking to their strategy abroad, there are also a lot of questions here at home. One of them is in regard to how the administration, particularly Elon Musk and his DOGE efforts, has been handling the firing of federal workers, and a very mixed response and a lot of pushback from American judges on how the DOGE efforts are being handled and how the data is being handled. What kind of pushback do you think will start to build, particularly as we head even further into the midterms, as they continue to try to cut costs throughout the U.S. government and the impacts that has on American workforce and American economy?
Well, there's two different strains. One is political and practical, right? We have government policies in effect that help or assist or serve millions and millions of Americans, 50 million, 70, 100 million Americans depend on things, anywhere from food stamps to veterans of Social Security. If they stop working, those millions of Americans will be very angry. And they will try to take their anger out on members of Congress, but that won't happen until 2026. And Trump is not on the ballot technically in 2026. But we don't want a lot of unrest. I mean, that's bad for the economy, it's bad for approval ratings, and it's bad for Trump's popularity. So there's a practical impact to all these cuts. But there's a political one as well, which is the House of Representatives, and now even the Republicans in the Senate are basically 100% aligned behind Trump. There is no breaking that bond that we can see right now in the immediate future. So unless there is a practical impact where the economy of towns where lots of federal workers were laid off, that they start to break, in other words, they start to flounder, and people can't get answers, that will push the congressional pressure. But how much the Trump administration regards congressional pressure in a time when even the Democrats sort of caved last week, that's a real question mark for us. As far as the courts go, Trump is pushing the federal courts in terms of balance of power with the executive as much, if not more, than Richard Nixon did. And we just don't know how this will turn out. The Supreme Court will be instrumental in ways that we probably couldn't even have imagined a couple of years ago on the overall constraint on the executive in the United States political system.
Wendy, leaving that aside, right? As an historian who has seen prior administrations try and reduce federal spending, seen prior administrations try and shrink the size of government, what kind of grade would you give the Trump administration, and what kind of likelihood is there that they actually managed to get our deficit down to 3% of GDP?
I have a more than $7 trillion budget. You have 2.4 million federal employees. Maybe now we have 2.3 million federal employees. If they've managed to eliminate 100,000 positions, still a pretty big government. The issue is you can eliminate the employees, but if you don't eliminate the programs themselves, the congressionally created programs that people depend on, then you're just going to have to rehire people or find another way to pay for the servicing of the programs. So reducing the scale of federal programs is something they haven't even begun to touch. So I just don't know how much progress they will be able to make. Some of these jobs have gone away to AI anyway, maybe not park ranger jobs, but other jobs that we've seen in bureaucracies. So how much of a dent they're making in the scope of federal government, we haven't begun to see that happen, and that will require Congress.
Wendy, we thank you so much for your time and analysis. This is obviously an ongoing discussion. We're looking forward to hearing your thoughts moving forward. That is Wendy Schiller of Brown University. And later today, we're going to hear from Council of Foreign Relations President and former U.S. Trade Representative Michael Froman. You're not going to want to miss that. It's at 4 p.m. New York time. This is Bloomberg.
Apple's upcoming iPhone 17, the main product, will still have a charging port. Apple has been looking into adopting a port-free design and will do so with its iPhone Air. But for the regular iPhone 17, it's going to keep a USB-C connector. This new phone, the main phone, is moving in the direction of a port-free future, and we'll see that with the slimmer iPhone Air, but the main one still is going to have a place to plug in. You don't really need it, right, anymore. I mean, I charge my iPhone every night just by a wireless connection, and I never plug it in for juice. So
I guess you can use the magnet.
Exactly. I use the MagSafe thing. I put it next to my bed. But the interesting thing to me will be if you don't have a port, you don't even have a place to put in headphones. You don't have a place for fast transfer of data. So
right. And what do you do when you're on a plane? Last night, I needed to charge my iPhone on the plane.
I'm sure.
So it kind of all ties together there. There's your tie-in.
I'm sure. Interesting to see Apple down this morning on the S&P right now. And we're seeing all the big tech stocks on the downside. If you put up your move function, you'll see NVIDIA, Tesla, Apple, Amazon, Meta, Broadcom, Microsoft, and Google, all the biggest losers in terms of deducting points from the S&P 500.
Yeah, it's interesting. Let's see if NVIDIA could turn that story around this week. So far, not looking good for today, though.
All right, that's all for Open Interest. Victoria Fernandez of Crossmark joins us tomorrow, as well as Goldman's David Costin and Ireland's Deputy Prime Minister. This is Bloomberg.